Hello, welcome to the Baker Holtz Tax Tip Video of the Month. My name is Michael Stadolski. This is my associate Alex Boss, and today we will be talking about some proposed tax law changes that could be coming in the near future. So I will let Alex start talking about some changes that will be coming on the individual side.
Yep, so just a few basic but important changes coming to individuals. First, we'll just start with a change in the top marginal tax rate for individual income earners, and that is going to increase from 37% up to 39.6%. And the reasoning behind this is to reverse the tax cuts that were made for high-income taxpayers in the last administration. Secondly, there will be some changes to long-term capital gain and qualified dividend rates for taxpayers with an AGI, which is adjusted gross income, of more than $1 million. These will now be taxed at ordinary income tax rates up to 37% and could be up to 40.8% if there is some net investment income tax. The reasoning for this is because it is viewed that the low capital gains rates that are in place now disproportionately benefit high income taxpayers. So this is an effort in their eyes to sort of level the playing field. Along with this, there will be a new proposal related to transfers of appreciated property. Gifting, a stock or an appreciated property, or in the event of a death, is now considered a realization event. And so for donors transferring an appreciated property, the realized gain is now the excess of an asset's fair market value on the day of the gift over the donor's basis in the asset. Some ways to potentially avoid taxation on this is if the transfer was to a spouse or to a charity. Now, if you transfer to a spouse and they sell it or they happen to pass away, then the taxation kicks in. And lastly, we'll talk about another important one, applies to a lot of people, is the child tax credit. This year, child tax credit is now being increased. It's increasing the age to qualify one additional year to include children who are 17 years old. And then just some details relating to that. The maximum tax credit per child would increase to $3,600 for qualifying children under the age of 6 and $3,000 for all other qualifying children. Phase out for these begins at $150,000 for married filing jointly, $112,500 for head of household, and $75,000 for all other filers. And then there is one more new tax credit regarding dependents. For dependents who do not qualify under the child tax credit, the taxpayer may claim a non-refundable $500 credit known as ODTC, which stands for Other Dependent Tax Credit. The goal here is that expansion of this tax credit will help to reduce child poverty by supplementing the earnings of families receiving the tax credit, and many more families are now being able to be included as well. So those are three, like I said, pretty basic but pretty important changes that will be coming to tax law in the coming years.
Thank you, Alex. Good summary there. Couldn't have said it better myself. So now we'll jump over to the corporate side. The first thing, in line with individual tax rates going up, we have that on the corporate side as well. So what's proposed right now is the corporate tax rate would go from the current rate of 21% up to 28%. And this would be effective for tax years beginning after 12/31/2021. Another change on the business side for flow-through businesses, so that would be S corporations and partnerships, is the taxation of either self-employment income or net investment income. Right now, a huge benefit of being taxed as an S corporation is that you do not pay self-employment tax on the distributive share of income that you have for owners that are active in the business. And then you also are not subject to the net investment income tax, again, if you are active in the business. A proposed change would make all income that is not subject to SE tax subject to the net investment income tax for taxpayers with AGI over 400,000. And the rate for the net investment income tax is 3.9%. So, and they are also starting to clamp down just in general on self-employment tax avoidance through S corporation status. So we could be seeing some major changes there in the near future. Another proposed change affects like-kind exchanges under section 1031. So current tax law allows for the exchange of like-kind real estate, really for the purpose of deferring gain that would otherwise be recognized upon disposition of the asset. The proposed law would cap the amount of gain that can be deferred under a section 1031 like-kind exchange at 500,000 or 1 million per year, depending whether you're a single filer or married filing jointly. And this proposal would be effective for exchanges completed in tax years beginning after 2021. So if you have a few properties you're looking at for 2021, it may make sense to accelerate those transactions before these limitations go into place. Another proposed change would affect excess business losses from pass-through entities, so again, S corporations and partnerships. And this isn't something that's new, it's just making a current tax provision permanent that is set to expire in 2027. And essentially what it is it's a limitation on the amount of losses that you can recognize from a pass-through business. Any amount that is over the threshold is just disallowed in the current year and carried forward to future years. And then overall, in general, we're seeing that there is going to be more budgeting and funding for increased enforcement, so we may see audit rates and things of that nature starting to go up. So,
Thanks for joining us for our tax tip of the month, and we will be coming out with some more tips and info for you guys in the coming months as well. Thanks.
thank you.